All right, picture this. It's Christmas night, 2025. You take a quick look at the silver price, and nothing. It's totally flat, just sitting there peacefully around $72. For the first time all year, that screaming volatility has gone silent. It feels safe, like you can finally take a breath. But according to the theory we're digging into today, that feeling, it's a dangerous illusion.
Because that silence, it's a lie. The theory says we are not in some calm harbor. No, we're actually in the eye of a massive financial hurricane, and the eye wall is just about to hit.
So, let's start by peeling back the layers on this illusion of safety you see in the holiday market.
See, there's this dangerous window that opens up right on December 26th. It's something professional traders whisper about. They call it Ghost Week, a time when the fundamental rules of the market just change.
So what in the world is Ghost Week? And why should anyone, be worried about it? Well, it's that week between Christmas and New Year's. All the senior traders at the big banks, the ones with the authority to move billions of dollars to keep prices stable, they're all on vacation. They've basically handed the keys over to a skeleton crew of junior traders and algorithms with one very simple instruction. Just don't do anything stupid.
And wow, this chart right here shows you exactly what happens. The trading volume, that's the amount of money actually flowing through the market, it just collapses. We're talking a drop of 70 to 90%. And this creates what's known as the most dangerous phenomenon in all of finance, a liquidity vacuum. Now, to really get what that means, think of the market like a frozen lake. On a normal day, that ice is 10 feet thick. A huge sell order is like driving a truck over it. Yeah, the price might dip a little, but the market holds firm. But during Ghost Week, man, that ice is paper thin. A big order can crack it wide open, causing the price to just fall through the floor, or on the flip side, teleport straight up.
Now, this theory suggests that this incredibly fragile market is on a collision course with other massive forces. All the ingredients for a perfect storm are coming together.
So you've got this three-part collision. First, you have the vacuum, right? That's the super low liquidity of Ghost Week. Then you've got a potential spark from a geopolitical trigger. And finally, the fuel, which comes from a huge policy shift at the Federal Reserve.
So what's the spark? The theory points to a reported flare-up in the Caribbean. The U.S. Navy allegedly boards a vessel to enforce its blockade on Venezuela. Now, with Russia backing Venezuela and China staying quiet, an event like this could easily trigger a massive flight to safety. And in those moments, silver is often treated as a war metal.
And the fuel for this potential fire? The source calls it the Fed surrender. See, right before the holiday, the Fed started signaling rate cuts for 2026, even though inflation is still way above their target. The theory says this isn't about fighting inflation anymore, it's about making it cheaper for the government to pay the interest on its $36 trillion debt. But that devalues the dollar, which forces investors to run for safety in hard assets, like silver.
But here's the thing. While all those catalysts are grabbing headlines, the theory says there's a much deeper, more structural problem that's been brewing in the physical silver market itself. So while everyone's distracted by geopolitics and the Fed, we need to ask a different question. What is actually happening inside the physical vaults? This is what's happening. Just 48 hours before Christmas, over 1.4 million ounces of physical silver, the kind that's registered and ready for sale, it just vanished from the Asahi refinery's vault in a single day.
And believe me, this was not some isolated event. COMEX data shows that if you add in the dreams from JP Morgan and other vaults, a whopping 2.2 million ounces of deliverable silver was pulled off the market in just 24 hours.
Okay, so this brings us to a huge paradox, and it's really important to get this. Normally, when prices hit an all-time high, tons of inventory flows into the vaults as people cash out and take profits. But here, we're seeing the exact opposite. This, according to traders, is the classic sign of a cornered market, a situation where having the physical metal is way more important than the paper price.
All right, so with this absolutely explosive setup on the table, what do you do? I mean, how does the source suggest you even begin to navigate the potential chaos ahead?
Well, looking back, history shows us these holiday periods can be launch pads. Both in 2010 and again in 2020, major silver rallies kicked off during the quiet of Ghost Week. But the theory argues that 2025 is 10 times more explosive, and it's because of one critical difference. This time, the physical inventory is basically all gone.
And that brings us to what might be the single most important warning from the source. Do not use high leverage. In a thin market like this, prices can create what they call widowmaker wicks.
These are instant, insane flash crashes that can liquidate a leveraged account in a single second before the price snaps right back up.
So the source games out two main scenarios. First, scenario A. Geopolitical news breaks and silver gaps way up to $75. The advice? Don't chase it. Wait for it to pull back. Then there's scenario B. The skeleton crews take some profit and flush the price down to 68. Here the advice is to buy that dip because a big drop can't last. Why? Because traders would instantly buy the cheaper US silver and sell it on global markets for a quick profit. That's called arbitrage, and that process alone would snap the price right back up.
But at the end of the day, the source stresses that all these crazy moves during Ghost Week, a lot of it could just be noise. The real signal, the moment of truth, will come on January 2nd. That's when the big boys, the senior traders, and all that institutional money come back to the table and finally show their hand.
Which leaves us with the ultimate question, right? Is the silver market a tightly coiled spring with a physical shortage and geopolitical tension just waiting to make it snap? Or is this all just a theory cooked up from holiday noise? The first real clues will arrive the moment those markets reopen.